Start off with brief introduction so we can get to the meat of the convo. But as I said, I'm from SustainVC. We're an early stage generalist impact fund, and we're based in Philadelphia, but we have offices in Boston, Durham, and Philadelphia. And with that, I'll pass it to my exciting panelists.
My name is Rajith Sebastian. I am one of the co-directors on the Penn Medicine Wharton Fund for Health. Can, I guess, discuss more of what that is a little bit later. I'm now part-time in my role at the Wharton School. I head up impact investments there, so a bunch of different impact investment programs. I work full-time for the New York State as head of sustainable investing for the New York State Insurance Fund. So I have, I guess, two views, both from an allocator perspective and from the VC perspective. So look forward to chatting with you all.
Good. Hey everyone, look forward to this session this morning. My name is Sean Dowling. I'm with Osage Venture Partners. We're based here in Philadelphia. Our offices are just in Ballackinwood. Invest in early stage business-to-business software companies. So we're typically investing in companies that are roughly $1 million of revenue, and we will lead or co-lead a seed or Series A round is the typical investment for us.
Hi, I'm George Krautzel. I'm one of the founders and managing partner of MissionOG. We're located here in Philadelphia. We are a firm that invests in B2B companies, so business-to-business companies, specifically fintech, software, data. We are investing right now of our fourth fund. It's a $170 million fund. We target 8 to 12 million into a company. We are coming in like a late A, B. Perspective I can bring to this is prior to MissionOG, I was an operator. I started a startup in '98. I bootstrapped it, scaled it for 10 years, and sold it to a public company. So I think I can bring kind of both perspectives here as a manager, but also I sat in your seat at one point in time in my life as well. So,
hello everyone, excited to be here. My name is Aston Pierce. I'm the director of the GoPA Fund. We're a growth stage fund focused on Ben Franklin technology partner companies. So once they hit that inflection point, typically at a Series A, Series B, we look to put in growth capital. We are a follow-on opportunity fund and a generalist investor, so we do look at B2B software, tech-enabled services, healthcare, so a variety of industries. But the goal for us is really to, as you approach that inflection point, we look to put additional capital in. We're currently investing out of our second fund. It's about 30 million, and I'm super excited to be here and chat.
Awesome. So if you can hear me, I'm just going to use my voice because I feel like I'm pretty loud. I'd love to start off by asking the room, how many of you, and just raise your hands, are entrepreneurs? Awesome. And how many of you guys have raised institutional capital before? Okay, cool. So it kind of gives us a good lay of the land of who we're talking to today. So I'd like to start off by asking the panel, just as a start, and I might actually direct it to George first, when is the right time for a company to be thinking about raising institutional capital? And by that we mean, from venture, as an example, family offices, larger people who can write larger checks.
yeah, it's always an answer that just based on farmers, but I always like to think about it that outside capital is never an answer. It doesn't solve a problem. It can be an accelerator, but that can accelerate two ways, right? That can accelerate up or accelerate down. So I think that when I talk about capital and need for it with young companies, it never should be in the way of like, we'd be a great company only if we had investment, right? That's probably not the case most of the time. I think that you asked specifically about institutional capital. I think Sean will probably have a good opinion on this since he's looking at things at seed stage and at Series A. But I always want to think about it as like you want to have certain things in place before going for institutional capital. So when you're early, it's all about kind of TAM, so total addressable market. Like you really understand like there's a big market out there, your team, who it is that's doing it, and the traction, right? Like, are you able to demonstrate that there actually is something there, or is this just a big dream that's going to hit somebody? If those elements aren't there, it's going to be really hard to reach from anybody, let alone institution. I think a lot of people in institutional capital want to see, louder? Sorry, okay. A lot of people
when it comes to institutional capital, want to see that maybe the company has been able to be efficient with capital that they've raised prior. So that's going to be angels, that's going to be friends and family. So I think a lot of times I think it's rare than not, and then Sean might be able to validate this, that someone's going to go straight from having no capital into the business than raising an institutional round. A lot of times there is that angel round or friends and family round, or the founder is putting money into it in order to demonstrate it. And that's important too, because that shows that you can be efficient with capital, and that's a really good proof point with it. I think probably, I don't want to dominate the conversation too much, but we can get a little bit into some of the KPIs or key performance indicators that are going to be important. But at that early stage, it's really team, TAM, and traction is how I think about it when you're first going out.
Would you like to add something? We were talking a little bit earlier, and you had some opinions. I feel like that would be worthwhile sharing.
I mean, nothing different to what George has said. I would just say that if you can, don't raise capital. If you have a business that can scale, if you can kind of bootstrap it, that's likely to be, from a long-term perspective, a better strategy for you. So I'm happy to dive into that deeper later, maybe.
Yeah, I'd say the other thing, especially at the stage that you're at, is really understanding what the key metrics that VC might have. Some, have revenue targets. Some have customers engagement. Some have retention. So I think being cognizant of when you talk to VCs is very important, because I do see sometimes entrepreneurs talk to VCs a little bit too early, and instead of focusing on the business, they put those conversations first, and I think they sometimes lose track or lose sight. So I think being very cognizant of, okay, we need to get this, this amount of revenue or this amount of traction. Now let's go out and talk to VCs. That could sometimes accelerate those conversations and move diligence along a little bit faster. So that's the only thing I'll additionally add.
Let me take a slightly different point of view. I think you asked the question of when you should raise an institutional capital. I think it's probably more of an if question. And if the answer is yes, then capital is important. I'm not sure Georgie can grow an institutional scale business without any capital. And bootstrapping is great, but it's also going to limit your upside. But there's businesses that is the upside. And I think you need to be realistic with yourself, with your partners, with whatever early friends and family investors you might have, about what the scale and potential of this business is. And that should determine which path of capital acquisition you're gonna undertake. And you're gonna need to evaluate that at every stage of the business, because that calculus changes every time you hit some sort of inflection point. And there's moments when let's put more capital in so we can take advantage of this huge opportunity, and others where you say, okay, let's get to profitability, and that's going to be the better long-term outcome. Just as an example, we've had 3 companies in our portfolio where the founders themselves all walked away with the same amount of money at the end, roughly $20 million. One was a business that they were early, very early stage, coming to us. We had a term sheet out to them. They got offered to acquire the business for $20 million, CEO 100% of it. So that's a great outcome. We had another business that we invested in. Business scaled nicely, and then it hit a little bit of a flat point, sold it for about $60 million. CEO owned a third of it, so made $20 million. We had another business that we were in for 10 years. They raised $100 and something million of capital. They sold for $600 million. The CEO walked away with $20 million. So I think there's a bit of, obviously there's different parts of that journey that made it's not just about how much money you walk away at the end, but thinking about the scale of your business and how you're gonna sort of participate in that journey yourself. And economics is gonna be important. So is the excitement of building a company and building a huge business and building a team and those sorts of things. So I would start with the if I want to raise institutional capital, and then a lot of other things we talked about are the when and how to do that.
I love that sales pitch for Osage. Come to us and we'll make
Yeah.
I think it's really great to hear all these different perspectives about, when, if, and how best to raise capital. Okay. But we started talking a bit about KPIs. So I wonder if we could hear from the table, because we all invest at different stages, how do you think about when the right time for your fund to invest, and what do the businesses typically look like, and what should they be thinking about when they come to talk to you? We can just pass the mic down the line.
Great, thanks. Very important question. So maybe I'll give some context on the Fund for Health. So, basically, this is a fund that's focused on the social determinants of health, so non-genetic factors that affect early Philadelphians. If I were to be more specific, social determinants of the health are the reason why a black male in West Philly might live years less than a Indian male living in Center City. I lived there for many years, so I'm just giving the comparison myself. But these include, your ability to kind of jog outside, walk outside safely, access to health insurance, access to financing. It's a big deal. In fact, more and more research is showing that these factors are more determinant of a person's health than your genetics. And so the Fund for Health was created by the Wharton School and Penn Medicine with a $5 million initial seed investment to invest in founders that were starting off innovations targeted at West Philadelphians mainly, or under Philadelphians across the city, that would address some of these issues. And so from our perspective, when we think about what we would invest in, we've got a very narrow lens. It has to, what is our thesis? Our thesis is of companies that are addressing this, and it could be companies using satellite technology to map out heat zones in the city. It could be companies that providing more access to healthcare through barbershops or through laundromats. So does it meet the impact thesis is a critical area. Does it meet our size threshold? So we're looking for early stage, so it's really seed to Series A. So we look at size and make sure that that's the right round, that's the right size. And then we look at everything that was mentioned earlier in terms of team, traction, so we dig deep into the financials. I think more than anything, you're really spending a lot of time on the founder. Do you trust this person in conversations? A lot of our founders don't have the most polished pitch decks. And especially when we're looking at, one of the things that I've kind of noticed or learned is people that raise funding often come with the most glossy pitch decks and often look the same. And we're trying to move beyond that. Can we look at, other factors about their history, about their success that could give us that information, as opposed to looking at what's been traditionally used. So we're trying to think differently about what we're asking for, because I think for far too long, venture capital and fundraising and fund investment in this country and the world has unfortunately led to outcomes where we're funding the same people all the time. So, yeah.
So you asked sort of KPIs of when we're first investing. We are writing $2 to $4 million checks into a sub $10 million total round, and then so that's sort of the round dynamics, how much capital we think this business needs and how much they're planning to raise, and then the revenue traction is an important KPI. As I said, it's more than zero. Usually our number is somewhere in $500K to $3 million of revenue run rate. A lot of that is dependent on the business model, so it's very different to have sell $3,000 annual licenses than it is to sell $3 million annual licenses, and so we feel much more comfortable at lower revenue thresholds with different business models. Those are sort of the core fundamentals. Like if you're not in that zone, then too early to talk to us or maybe too late to talk to us. And then within that, there's a whole bunch of different qualitative factors that we think about as we decide whether this is an investable business or not. One of them, maybe to go back a little bit to that question of if you should be raising venture, we're all here to deliver great returns to our investors who invested in our funds, and those expectations are that we're going to deliver 3, 4, 5x their money, and we're taking a lot of risk to do that because those are pretty exceptional returns that we're tasked with. So that means that every investment that we're making, we need to believe that it's going to deliver us at least 10x, and ideally can return our fund. So I have a $100 million fund. I need to believe that the dollars I'm putting into this business are going to return $100 million in the end. That requires a big outcome that sets high expectations for growth and what that means from expectations of your board and your investors and those sorts of things. So that's the story you need to be able to tell to an early stage investor, is how do you at least 10x your money? How do you 100x your money? And I think that's a lot around the TAM, which George mentioned earlier. Is there a huge opportunity here? And then for us, what's really important at that fundamental level is, are you solving a really important pain point to your main customer? And are you delivering an ROI that's sufficient to get them to move their behaviors? So if you're not in the top 2 or 3 problems that your buyer is trying to solve at any given point, even if you delivered a massive ROI, it's just not where they're focused on, and time and attention are short. And so that's a core thing that we emphasize. And then, as Rajith said, team is everything, particularly the stage we're investing in. So we spend most of our time on that.
All right, so just to kind of break it down a little bit further and play off of what these guys are talking about. So I think there's a spectrum, and your investor changes as your company matures and grows. So if we're talking about first institutional capital, like seed capital, I'll go back to what I was saying. It's that team, it's the traction, it's the TAM. Those are the things you have to do. You have to be able to show a use case or be able to have somebody understand, okay, what's the problem that you're solving? I always like to think about it, it's like seed investors are vision investors. As you start moving up the scale, it starts to become more math-oriented, where you have to be thinking about math. So if seed is that, Series A, which is where Sean plays and where we spend time too, you really have to start showing math-based answers to things. So things like your unit economics, like your margin of your business comes into play a lot more. Your go-to-market motion, how your numbers as far as how much costs it, to obtain a customer, and then the value of that customer goes up. As you start to move out into like Series B, it becomes a lot more math-oriented. That's where you have to be able to underwrite a business and show that it's going to have progress and sustainability. It's, that's where a lot of the financials come into play more. But if we rewind, because I think primarily we want to stick on seed stage here in this conversation, it's really about being able to lay out a vision and then have some of these numbers behind it that support that. And then being able to really detail a use case. I think that's so important. The other thing I want to kind of mention is, you're going to want to treat your raise process like a sales process. We looked at 702 companies last year. We invested in 2 of them. All right, that's not good odds. Okay, so you're going to have to run a process where you're going to have a lot of guys like me or Sean or Alton here, and just be able to know that your chances of getting investment from that specific individual are probably very, very low. And that's not a bad thing if you understand that. It's the same thing as like a sales process. If you run a sales pipeline where you think you're going to close every deal, that's not a good sales pipeline, right? So you have to start thinking about it from that standpoint and put the investment necessary to really source the most likely investors, and then you really kind of lean into where you're getting some traction from them. But maybe we talk about that a little bit more as this goes on. But that's as equally important as anything else, is really understanding how to manage that process.
You want your sales conversion rates to be better than your venture conversion rates. Yeah.
Yeah, not to echo everyone here on the panel, all made great points. Specifically talking about our fund, we typically invest after Ben Franklin has seeded a company. And so we write $1 to $3 million checks, what we consider at the growth stage. The stage we say we play at is what they consider early growth equity. So it's usually 3 to 10 million of ARR or run rate. And that's really businesses that are kind of hitting that inflection point. That's everything outside of life sciences and medical devices. If it's in that space, we actually can go a little bit earlier and get in before pre-FDA approval. Because we are a generalist fund, we honestly look at a lot of different aspects of the business. But when I'm looking at business, the kind of 3 things I initially look at is like, what's the problem? How are they solving it? And how big is that problem, right? In terms of market size. And so like getting to that very quickly is the key for me, because sometimes people don't really discuss like how big is this problem, right? Is this a real pain point? And is it gonna push that consumer to actually buy the product? A lot of times when you're actually selling something, there's really 2 outcomes you can think about, right? It's either this is gonna generate more money for that business, or it's gonna cut expenses. And so I think really getting to that early in those conversations is really important. And then of course, like the other panelists alluded to, you do deeper due diligence, right? You look at the team, you look at traction, look at customer retention, ACV. So it's all these things that we expect entrepreneurs to have. And that's one thing I tend to emphasize, especially when working with very early stage companies that haven't fundraised before, is understand how to get a virtual data room together, have all your documents in hand, because I think sometimes people forget that, and that can actually make the due diligence process a little longer. So really being prepared to go out and fundraise is another key element I like to emphasize.
So something that I'm hearing from all of our panelists, diverse range of perspectives, diverse range of funds, but I'm hearing a lot of know your audience, right? There is the saying, you miss 100% of the shots you don't take, but in VC, you're going to miss a lot of shots, but there is something to be said about, going for the funds that are going to be the best fit. So as an example, SustainVC is an impact fund. If you come to us with a business that is not doing a social or environmental good, no matter how awesome you are, it's not a fit for what we're doing. And unfortunately, I can take a look and I can try to be helpful, but already it's not going to be a fit. So continue to think about that as you are thinking about venture. And all of these funds have different parameters, but they all said key things that they're looking for. And on that note, everyone here is an experienced investor. I would love to hear, what are some of the 3 indicators of success that you've seen throughout your time investing? And since we went this way last time, Aston, can we start with you this time?
Yeah, of course. So I think for me, the 3 things I initially look at is first thing is like growth. So that's customer traction. How's the business growing either month over month or year over year? Are they accelerating in terms of acquiring new customers? The other big thing is I look very closely at like how they're thinking about acquiring customers in that specific market. One thing I tend to see or sometimes see is people underestimate the size of the TAM, right? And how much they can obtain of that market. So it's really being thoughtful on, is this a market that's growing? Is my solution capturing that audience? And so being really thoughtful on how you assess the TAM and making sure that's accurate. And then I think the last point is then just like differentiation. How do you differentiate? Why is your solution unique? A lot of times you'll see large incumbents in the place or in the space. And what are you offering besides for instance, price? Is it unique IP? Is it the technology? Is it speed to market? Is it time to value? So I think really unpacking, what's your value prop and how you're differentiated in that space are, some of the key elements I initially look at when assessing opportunity.
So it's hard to boil it to just 3, but I'll just take a shot at a couple. So I'll go quantitative and then qualitative. On a quantitative standpoint, growth rate, as mentioned, you rarely see a company as it matures accelerate its growth rate. So you want to see especially with the areas that we invest in, we want to see a really strong growth rate already, and knowing that law of big numbers, you're going to be able to at least keep up or maintain a similar type of growth rate. Net retention and gross retention. So just to break that down, gross retention is how much your customers churn. So on an annualized basis, are you able to continue on with those customers or not? That's your gross retention. Net retention is how much you're able to increase their spend over time with you. Those become really important numbers. And then for us, capital efficiency is really important. It gives us a better idea of like the DNA of the company and understanding how that company has been able to treat capital that's in it before. And a lot of times when we come into a company, they've already raised capital from other investors prior. So that's on the quantitative end. On the qualitative, there's so many things. I would say, we try to really get an idea of like the grit of the team and specifically the founder, and be able to see demonstrable evidence through their experience and their background that they're able to run through walls. Because if you can't, this isn't a job for you.
Try not to repeat things that have already been said. I guess maybe on the quantitative side, George mentioned unit economics before, and what that means specifically is, are you able to acquire a customer in a profitable way, essentially, and is that a sustainable thing that you're able to do over time? So you look at the amount of how much it costs you to acquire that customer, and then you compare that to the contribution margin you're getting from those dollars, or what their revenue is, and your gross margin. So the combination of those three things is really important to show that you have a sustainable growth engine. To George's point, that you're going to be able to maintain those growth rates, and that the capital you're going to invest in that go-to-market exercise is going to be a profitable investment. So I think that those unit economics. And it's very hard to do in the really early stages of a business. Often the founder is the person who's out selling. So how do you allocate your time to your sales and marketing costs? So I think what's most important is actually setting up the systems and knowing that you're tracking those data points as they come in and being realistic and thoughtful about what those unit economics are. And then maybe I'll go a little bit deeper on the team side of things. I think we look for domain expertise, which is related to what I said before around your ability to understand the problem you're solving and knowing why that's super important and how you're going to deliver value to your customers. So domain expertise is important. Then the second thing is your business building intuition. Sometimes it's expertise because you've been in a rapidly growing company before and you've seen what works and what doesn't work. You've known how to put systems and processes in place that are going to let a business scale. You know how to hire. So that would be the third elements on the team. I could go a lot deeper, but that is crucially important to us. Do you have the humility to recognize you're not going to be able to do every job? You're not going to be the best person to do every job in your company, and go out and hire people who are better than you, first and foremost. And then second, are you able to actually attract them to your company, sell them on the vision, and help them understand why they should come, spend their time and their talent chasing your vision. And so I think that ability to hire talent is something that we look out for and is really crucial to success.
Difficult to add on to this, but basically, I guess what I agree with is, traction in terms of economics and top line, super important. In terms hiring decisions, again, very, very important. Who is their second hire? What's the quality of that person? Who's the third hire? But beyond that, I think we might be looking at a little bit earlier stage than some of the others here. And so, how organized are these founders when they're talking to you? Do they actually show up for the meeting? Are they like juggling between 10 million different things? It's pretty basic things. Are they? Do they send a thank you note? Do they send a good introduction note with their pitch deck? I know I said we don't look for glossy pitch decks, but at least the email, run it through ChatGPT or something if you need to, so that it comes across as a little bit more professional. I think at the early stage, you have to kind of hustle a little bit more than at the later stage. I was listening to my counterpart, and we talked about a lot of metrics, a lot of different things, and the whole time I was thinking, geez, the reason I mentioned earlier, if you don't have to raise, that sounds like a ton of things to do or to watch. If you do raise, kind of have behind you, have you met this, have you met that? And so I think that's one of the challenges that early stage founders have is, do you have the right partner? And so I'm sure that's coming, how, on the one end, we're looking at you, but you've got to, as a early stage startup, also be picky. Who are you partnering with? Is it a long-term partner that's going to basically be forgiving 1 or 2 quarters or something beyond the process? So we look for founders that are also looking at that, whether or not we're the right partner for them, because I think that makes for a better long-term partnership.
I also want to add on to this. This may seem like a joke, but in terms of, running it through ChatGPT, one perfect way to, immediately, make the conversation on a wrong note is to get someone's name wrong. You're trying to look for Kendall and you send an email to Sean. That is, it's a small thing, but it makes me feel like you don't actually want to talk to me. And as someone who also plays in the seed and pre-seed space, it's tough. I understand, but I am Kendall, and I'm also not a sir. So, I also want to draw attention to the poll EV. We're going to open it up to questions from the audience in a few minutes, so please fill that out. But I would remiss to have...
Is it okay to ask questions if you don't have my phone?
Yes.
Okay, yes, it is. But I want to ask one more question, this specifically to Aston and Sean. I would be remiss to have a panel on venture if we didn't talk about how to think about exits and to communicate, the long-term plan. A lot of people here are early in the journey, but it's never a bad time to communicate that to your investors that you're thinking about it. It's another way to show that you're organized and you're thinking about the long-term vision, because as venture investors, we do also have to think about an exit. So,
I mean, we're investing on 7 to 10 year timelines. So, yes, you should be thinking about an exit. Yes, by taking venture, you are automatically guaranteeing yourself on a path to some sort of exit in a 7 to 10 year time period, because that's what your investors are gonna be expecting. How much time and effort you put into that in the early stage is I think relative to your business. I think there is an element of, you need to be able to, as part of that story that you're telling as you're going out and fundraise of why I'm going to make $100 million when you eventually sell this business, you need to have some presumed path of how that's going to happen. And it's got to be a little more sophisticated than we're going to go public at some point. We're going to be relevant to these sets of buyers for this reason. But I didn't put a whole lot more effort into that part of the process because it's so early. I think what is important, though, is thinking about who your potential buyers could be and building relationships with them early in the business, and because they can be partners, they can help you go to market, they can bring you data, they can do a whole bunch of other things that can move your business forward, and you're building that depth of relationship, because when the time does come to exit, those partners are going to be the likely ones that are going to be acquiring you. That also, as you get later stage, those partners become financial buyers as well, and you want to build relationships with them over time. So I would think about it as an iterative, build relationships as you go over time, but don't over-index on it in the first meeting you have with a Series A fund.
No, I would echo that sentiment. It's something from an investment standpoint we consistently think about. But I'll be candid. A lot of people will talk about it, but it's not the main priority, especially when you're year one or year two. It's really how do you get that product out to market, and then you think about exiting or selling it. So really, it's like, how do you create the best product? How do you get this to scale? And then everything else, I think, starts to fall in place in terms of partners and people looking to acquire the business. I mean, when we underwrite a deal, the biggest thing, and the panelists allude to this, is the market, right? Is this a big enough market where a bigger competitor is going to want to acquire your product or platform and potentially build it into their solution? So I think understanding who they could be is great, but I agree with Sean here, like over-indexing on spending a ton of time on thinking about an exit when you're pre-revenue or pre-product is just not a great use of time.
One thing Aston said that triggered for me, I would think about whatever the next milestone is. So you're raising capital to get to some next milestone. If you're raising Series A money, that milestone is unlikely to be an exit. It's likely to be a next round of funding, or it might be to get to profitability. And I like to do an exercise just before or just after we invest of like what needs to be true for this business to reach that next milestone. So you lay that out, say, we want to get to profitability, we want to raise a Series B, whatever it is, and then you say, this is what we need to look like in 18 to 24 months, and then work back from there to help sort of inform some of the decisions and priorities you're going to make in terms of how you allocate that capital.
Awesome. So now we're going to open it up to audience Q&A, and I'm cheating. I did get one through the poll EV that I think is really interesting, so I'm going to start with that one, and then we'll move to the hand raising. But how have you seen companies fail, and what are the common reasons for them shutting down? Which one of you wants to take it?
There's a ton of reasons why things fail. I think just to kind of put them in order, I mean, generally they overestimate what they have, and they overinvest in growth initiatives before understanding if what they have is really worth the chase. So that is something where, you see a company that, going out for world domination, but maybe the product or solution isn't sticky with its customer base at all. And, they end up just getting themselves into a problem later on down the line. Team can't get along. That happens where, you have something that has a lot of potential, but they can't get the people part of it right. You always see where something is quickly a legacy solution. where, maybe at the time it was something new that people were willing to bet on and try on. But, competition ate it up, or, they just couldn't accelerate the business past, where they were, and, technology changed, technology improved, it differed. So there's a lot of reasons for it. I think companies that stick to first principles, which focus on their customer, that focus on delivering value to their customer and then expanding based on that, are the ones that try to reduce that risk. But at any point in time, there's things that can take it out.
I might say, as a little extension of that, failing to be intellectually honest with what you have. So I think a little bit of, you can overestimate that you've built the greatest thing in the world, or that your competitors are no good, or that the market is ready for your solution. But if you're not taking the facts and the data that are coming into you with a realistic lens, and maybe a pessimistic lens, I think that can often cloud decision making in negative ways. And entrepreneurs are internal optimists, right? You always want to see the positive because you're embracing the unknown and chasing down the possibilities, as we talked about earlier today. But you also need to step back and make sure that you're looking at things with a realistic perspective as well.
One additional thing to that, I think being very cognizant of runway, that's something, I think all investors look at. How much cash do you have month over month? How much are you burning? I think one key thing George alluded to is sometimes people spend too much on a product without being cognizant of their expenses. So being very thoughtful. If you don't have product market fit, manage the team accordingly. We've seen companies in the portfolio grow to 100 employees just throwing out a number, but 100 employees and don't really have the product market fit yet, right? So it's really being cognizant of how much am I spending month over month, tracking that number, and then does the revenue or the metrics that we're getting for the employees that we have hired actually make sense? And do you see the revenue growing month over month from that? So I'd say that's another really key factor. That businesses, they run out of money. I mean, that's, if you can't raise, that's a big issue.
Any questions from the audience?
I wanted to address that early stage friends and family ideology, especially for there are people in this world for whom that, if you say friends and family, it's kind of like saying, okay, get yourself to the moon. And when we look at the numbers, actually like 2% of women get funded. When you say African American women, that's 0.7%. And I get that this is not philanthropy. You're raising capital, you have a business too, but there's a lot of evidence that shows you're leaving money on the table by leaving these people out of the conversation. So I wanted to get your perspective on, are there things that you're thinking about to address that? And with just a second part onto that is, in the very early stages, pre-seed institutions often have a form that you fill out, and they want you to upload your deck. I have noted that if you don't meet whatever it is on that form, you don't even get to look at your deck, because my deck has it so that if on my website I'll know someone's looked at it, and I'm getting responses, you're not ready, but I've just answered like 5 questions, so multiple choice questions. And there's statistically, that's actually, it might miss outliers. That's called regression towards the mean in statistical terms, because if it doesn't meet these very, very, very narrow specifications, then you're not even getting to the point to understand why that is. But those are the 2 questions.
I can take a shot. So a couple of things, and I'll take it in reverse order. On the first one, on not meeting certain qualification, one thing you have to understand: institutions, when they raise capital, so firms when they raise capital, they have parameters that they set where they go out to their investors where they say, this is what we're investing in. And if you don't match those things, they're not going to take a look at you, right? So that's where I get back to the initial point of saying that you have to run this as a process, as the most important sales process. If you're the CEO of the company, this is your job, is to make sure that you finance the company. So you have to put a lot of work in to do it. And part of that work is figuring out likelihood to succeed. You're not going to find an investor where you're like 100% that investor is going to go with it. But if they're have a better chance or slightly better chance than the other ones and spend more time and energy that way. To relate that back to your friends and family or angel, conversation, it's not that much different. Now, friends and family can't change someone's network, but that's where you have to put the work in. So, if I'm you, if I'm looking to say, gosh, I want to raise money from angels or friends and family or, non-institutional, you still need to put the work into the who, right? So, because they're, that who is going to have a higher likelihood of investing in you or not. So figure out who successfully has built businesses in a space that you have, because your likelihood to get some traction with that person on a conversation, if you have a business that's innovating in a space where they've had success, is going to be so much higher. So that's the part of the work that you have to put in. So if I'm anyone in the audience here and I'm looking to raise from angels, that's hard to do, right? And they get a lot of people going to them and looking for capital, but do a lot of the work and research to understand the likelihood of it. And then just one real quick hack with firms. A lot of firms pay attention to people that are their investors or advisors or people around that. So if you can get a referral into a firm that says, take a look at this, and it's a trusted resource, you're going to improve your chances so much more than just a blind email. So again, that's part of the work process, and that's a bit of, I didn't know that before I was in this industry, but how much of a premium that people in the firm put on it. And that could be an ex-entrepreneur, like that could be somebody they backed before, that could be advisors, but there's usually tentacles or ways to get into firms. And if you can get through a referral, your chances are so much higher to at least have a conversation.
If I can, I want to address that question. So according to the Knight Foundation, the research is less than 2% of assets in the US are owned by minorities or women. So less than 2%. That's shameful. It's been about the same for the last 10 years. So as much as we talk about these issues, not much has changed. Friends and family, not many minorities right now have friends and family that they can call on. So I think there's also implicit bias across the investment space. I mean, I work at a large asset owner, and something that we look at with our very large fund managers, in terms of who they select, and it's something that you're going to face. Unfortunately, it's tough to kind of change implicit bias, and we can do all kinds of trainings and tell the whole world. I think what you can do as a woman looking to raise space, just know you are up against it. And now what do you do? So maybe getting a board of directors, an informal board of directors, asking Sean to be, your on your informal board so that you can call on him. He has networks that you can leverage. So you may not be able to leverage them directly, but try and figure out indirectly how can you leverage that. It is tough. I think that I started off by saying if you don't have to raise, don't. And the reason I said that is there are other non-traditional ways of getting capital. So the government, there are a lot of government grants out there. See how those can tide you by. A lot of foundations that are looking at concessionary capital. Think about that too as an option. At some point you may need to raise, but especially as a minority or a woman, the data suggests it is tough. And so you got to figure out how to, kind of manage through that.
So I think we're technically at time, but I would be remiss if, as a woman of color, I did not also speak to your question. As we just said, the goalposts are moving and things are changing, and it is a hard world out there for us. But one of the reasons I got into venture was because I wanted to help advocate for more for women of color and getting us into this space. And as things continue to evolve, the processes are not perfect. But one thing to take hope in is the fact that you've seen these forms on websites, right? In the past, venture was entirely based off the referral system. So if you think about it, your network looks like who you look like. And if you're entirely based on the referral system, it's really hard for people who look different to get in the door. The benefit of the form is that it normalizes the goalposts. Everyone has to go through the same door to get into the door to the VC. It's not perfect, because if you aren't necessarily checking the boxes, you're not going to get in the door. But you can have hope in the fact that everyone who does not check the boxes does not get in the door. And that's important. And we have to, think about things with hope. We don't build Rome in a day. It takes steps, and we're trying, and it's progress. But I wanted to say thank you to all of our amazing panelists, and thank you for letting me moderate. And I hope you enjoy the rest of the day. Thanks for coming.